Welcome back to Squawk Box. Well, let's get back to our panel of guests. We have Ron Ianieri, Chief Options Strategist at the Options University here in the Singapore studio. And also joining us is Arun Motiani, Head of Macroeconomic Research at Citi Global Wealth Management, and he joins us live from New York. Arun, let me get to you first of all this time. We had some rather scary comments coming out of the former Chief Economist of the IMF, Kenneth Rogoff, saying the worst of the global financial crisis is yet to come. A large U.S. bank will fail in the next few months as the world's biggest economy hits further troubles. What are your thoughts on that sentence?
Well, I mean, he's obviously talking about some sort of systemic problem which will affect a handful of institutions. I mean, I have no idea what his information is. I mean, you know, Ken is the former chief economist. He knows Ben Bernanke very well and probably Tim Geithner. I'm not sure whether there's some inside information there. I'm not hearing any such thing. I'm an economist furthermore, and I mean, if there was any suggestion that I should sort of bite the hand that feeds me, I'm probably not going to do that. And besides, I don't know. As I said, I'm a person who looks at the economy rather than looks at individual names. But I mean, I suppose Ken is concerned because I mean he is worried about the fact that the whole financial system is under severe stress. And I think he wrote recently a piece saying that why should the financial services industry not be treated like the airlines industry? So I think we have some general idea of his drift.
Interesting stuff. Okay, Arun, look, we won't put you in a position. You're with Citi, of course, but Ron, let me get to you. Goldman out, we were telling viewers overnight, downgrading more Wall Street banks. Situation is going to get worse, they think. Their favorite pair trade, long Morgan, short Citi. Is that something you do?
Well, you could put me on the spot. I think that Morgan is probably one of the 2 or 3 best positioned. It's in my top 3 in terms of long-term aspects. I think that a couple of banks are going to come out of this situation, although be it over a period of time, they're going to come out much stronger because you're going to see a lot of consolidation, a lot of weakening of their competitors.
Which do you think is the most likely to fail if we're just going to go on from Kenneth Rogoff's
I'll tell you,
comments?
I think Lehman is definitely right there. They're caught between a rock and a hard place. You know, they have to raise capital, and their only real asset that's performing right now is probably the only thing that has any value. And unfortunately, that value is not all that great because, 1, we're in the economic time we are. 2, everybody knows they're probably going to have to sell it. And 3, there's nobody out there else that has money.
In other words, they've got zero leverage, right?
They've got zero leverage. They have to do something soon. It's obvious if you take a look at the way Lehman is trading, the news that's out. They're in a severe situation. And I think Ken for the ex-IMF economist is right. I think we are going to see maybe more than just one. I think there's probably 2 whoppers that are sitting out there.
Ron, if I could just come in here, the consensus amongst the options traders yesterday in the market is that Lehman stock will keep falling. But one of the top trades apparently was a bullish bet that that the stock would recover to trade above $20 between now and 2010. Are you buying into that?
Well, you have to remember, 2 things. Number 1, because the volatility is so high, I don't want to get too technical, but when a volatility gets very high in an option, what winds up happening is all those spreads, the vertical spreads, tighten up and become very cheap. So it could be just a cheap bet that someone's taking. Number 2, we don't know what they did on the other side. They might already have a short stock position or some other short position that they have to hedge just in case they're wrong and the stock runs. Remember, everyone's trying to cut back on their risks. So whatever bet you make, you have to hedge. We don't know if that was an offensive trade or some type of hedge in case they're wrong on their real bet, which could be on the downside.
Okay, Ron, hold those thoughts. We'll get back to you very, very shortly. In the meantime, thank you very much to Arun Motiani, Head of Macroeconomic Research at Citi Global Wealth Management.